Let's imagine that you'd like to buy shares of a stock like, for example, Bank of America. The thing is, the stock right now is actually quite high and you're quite afraid that the moment you're going to buy the shares, the stock is going to plummet just after. So what should you do? Should you enter the position, buy shares of Bank of America right now, risking that the stock is going to dip just after? Or should you wait until the stock falls and probably get in into a lower price? However, you don't know if the stock is going to pull back. So what should you do in this type of situation? And if you're in this type of position quite often when you're trying to get into a position, I actually have some good news for you. And that good news is called the cash secured put strategy. Selling a cash secured put essentially means selling a put on a stock that you wouldn't mind owning and setting aside enough cash so as to cover potential assignments. And stay with me if you don't understand clearly what is a cash secured put. I'm going to give you examples so it's completely clear. But before diving into this video, if you like this type of content and you'd like to see more videos like this one, please consider subscribing to my channel. It's free and it supports me a lot and I'd really appreciate it. So as I said, a cash secured put is selling a put on a stock that you wouldn't mind owning. And in this type of case, there are two possible outcomes. Either the stock continues to go up, and in that case, the put that you sold expires worthless. And if the put expires worthless, then you keep the full premium, meaning that you make a profit. Or the stock falls and your put expires in the money. And if your put expires in the money, then you're being assigned 100 shares of the stock. But remember this is exactly what you wanted in the first place. You wanted to buy shares of the stock directly, except that you were afraid that the stock would fall directly after you bought shares. Hence, by selling a put, you're essentially being paid to wait. Because if the stock goes up after you sold the put, then your put expires worthless and you make a profit that way. And on the other hand, if the stock falls after you sold the put, and your put expires in the money, then you have to cover the assignment and then buy 100 shares of the stock. But that's exactly what you wanted in the first place. Remember that you wanted to buy shares of the stock anyway. And by selling a put at a lower strike price, then you're entering the position at a much lower price per share than if you had directly bought shares at the beginning. So let's take an example so it's completely clear. We talked about Bank of America, so let's stick with that stock for the moment. Right now the stock is around $34 per share, and as you can see, the stock had a major comeback since November. It went from $24 per share to now $34 per share. And let's say that you wanted to buy shares of Bank of America, except that right now you see that the stock price is around $34 per share. And what if the moment you buy shares, the stock actually dips just after? It would be quite bad and would put you into a loss. So instead of buying shares directly of that stock, let's start selling cash secured puts. So let's imagine that we go into the February expiration, for example. So you see that you have all of the option chain and you can see all of the strikes available. The important thing here is to sell an out of the money put. Why? Because you want to buy shares at a lower price per share than if you had bought the stock directly. It makes sense to sell an out of the money put. So at least if you're being assigned at a strike price that is lower than the current stock price. So in our case, let's imagine that we sell the 31 strike. You see that I would collect here a credit of 39 cents, which would equal of a max profit of $39. Meaning that if the 31 put expires worthless because the stock continues to go up, then you keep the full premium and you make a profit of $39 that way. And if the stock actually falls and your put expires in the money, then you're being assigned at a price of $31 per share and you will need to cover the assignment. And as the contract controls 100 shares of the stock, then you will need to buy 100 shares of Bank of America at a price of $31 per share. So $3,100 of assignment. So you see that it's completely a win-win situation in both outcomes, because you want to get into the stock anyway. If the stock continues to go up, then you keep selling puts and you make profits that way. And if the stock falls and then your put expires in the money, then it's at that point that you buy the 100 shares of the stock. That's why I really like this strategy, because in my opinion, if you want to buy 100 shares of the stock, you really better use the cash secured put strategy, because at least you're being paid to wait. And instead of waiting on the sideline for the stock to fall and buy the shares at a lower price, and why not selling puts and at least you being paid to wait? And understanding this strategy is very powerful, because now, compared to the people that just wait on the sideline to buy the stock at a lower price, just sell puts. Just sell put at lower strike prices so you're being paid to wait. And when the stock falls, then at least you enter the position at a much lower price per share than if you had bought the stock directly. And here's my philosophy philosophy on the cash secured put strategy. And note that this is only my opinion, and this is really what I want to share with you because I think this is really a great strategy. On top of trading options, I have a long-term portfolio of dividend stocks that I maintain, and I really want to accumulate wealth over time. And in my opinion, the cash secured put strategy really makes sense here. Instead of buying the stock directly, for example, let's imagine that I wanted to buy a dividend stock and I really like the company and I really believe in it, except that I feel that the stock right now is really expensive. Instead of buying shares of the stock directly, I could just start selling puts on the stocks until I'm being assigned. That way, I wait for the stock price to fall, and when the stock price falls, at least I buy the shares at a much lower price than if I had bought the stock directly. And by doing this, you make money in several ways. You make money first by selling puts that are expiring worthless, so you're being paid to wait, and then once you're in the stock at a much lower price, and then you start earning dividends. So by doing this, you really have a lot of income sources that you're actually creating for yourself, rather than just buying the stock directly in the first place, risking a pullback. And I think that over time, accumulating shares of stocks by using the cash secured put strategy is really powerful. And actually, Warren Buffett is doing this a lot. In his 2008 annual letter to shareholders, he, for example, says that he sold puts on indexes right after the crash on all the major indexes. And if the major indexes would fall even lower, then he would get assigned at very low prices, which is exactly what he wanted. And if the indexes would actually come back up, he would keep the premium and make a profit that way. And if I remember well, he sold puts equaling $34 billion. So obviously those sums of money are huge, but the concept is really the same. The concept of the cash secured put strategy is really widely used and it's really profitable. But what's the downside of this strategy? Well, in my opinion, there is really one major downside to this strategy. The thing is, you are forced to buy 100 shares of the stock. As one option contract controls 100 shares of the stock, it becomes very difficult for people having low capital and small amounts of money to use that strategy properly. Because here's the thing, if you wanted, for example, to trade a stock like, as I said, Bank of America, with a strike price around $31, then you will need to put $3,100 on the table directly so as to cover potential assignments. And that can be quite costly for a lot of people, and not everyone has that much money so as to put on just one stock. Hence, it's very hard if you don't have a lot of capital to really use this strategy on the long term because it takes so much capital right from the start. And if you already have a lot of capital, I think that using this strategy so as to acquire wealth and so as to acquire shares on the long term is probably the best thing to do. But for the people that have low capital, that have small capitals, what is the best use of this strategy? Is there even a use to this strategy, or is it only made for people having bigger capitals? And I think there is a way that you can actually use this strategy even if you have a small capital. And that way is the following. Let's imagine that you start selling cash secured puts on a stock, and now you are being assigned 100 shares of the stock. As we said, for example, you're being assigned of Bank of America, and you have to cover the assignment and put on the table so as to buy 100 shares of the stock, $3,100. After you've been assigned on that stock and you actually bought the 100 shares, just start selling calls against it. And that's what we call the wheel strategy. By selling calls on the stock after you have been assigned on the puts, well, now you're exactly in the same position but on the opposite side. If the stock continues to go down, your call expires worthless, and in that case you keep the premium. And if the stock goes back up and your call actually expires in the money, then you have to sell 100 shares of the underlying. And you actually have those 100 shares because the 100 shares came from the put assignment you actually did before. So now you just sell the 100 shares that you had bought with the put assignment. And by doing this, it's actually quite a good way of trading options and making money that way. And you see why we call that the wheel. Because first of all, you sell a put. Either it expires worthless and so you keep the premium and make a profit that way, or you're being assigned and then you have to buy 100 shares of the stock. And after that, once you're being assigned and you are now the proud owner of 100 shares of the stock, then you start selling calls against it. And here, same thing as the put. Two outcomes possible. Whether the call expires worthless and then you keep the premium and make a profit that way, or the stock goes up and your call expires in the money. And in that case, you need to sell 100 shares of the stock, the same 100 shares that you had acquired by selling a put and you got assigned on it. And in my opinion, using the wheel strategy is really the best way for people with small capital so as to benefit from this type of strategy. What is very important to remember here is that you really need to use this strategy on cheap stocks if you have a small capital. Let's take for example American Airlines. Right now the stock is at $16 per share. And if you were for example selling a put around the $12 strike, then you will need to put $1,200 in case if you are being assigned on that put. And now $1,200 becomes a lot more affordable than if you were wanted, for example, to sell a put on Tesla, where if you were being assigned, for example, at a strike of $800, then you will need to put $80,000 on the table so as to cover the assignment. So you can see that there are major differences based on how expensive or how cheap is the stock. Hence why I say that if you have a small capital, just focus on cheap stocks so you can actually afford the assignments. And in our case of American Airlines, for example, if you were selling a put around the $12 strike and you were actually being assigned on that put, then you will need to buy 100 shares and put on the table $1,200. And then, once you are the owner of 100 shares of American Airlines, start selling calls against those shares, and now exactly the same thing happens. Either the call expires worthless and you keep the premium and make a profit that way, or your call expires in the money, and then you need to sell the 100 shares that you had previously acquired with the put assignments. That's called the wheel strategy, and in my opinion, if you have a small capital, that's a really good alternative compared to selling just cash secured puts and acquiring shares that way. However, if you're focusing on long-term growth and really amassing wealth and shares, well, I think the cash secured put is really the best strategy overall, because it's going to allow you to really buy shares at lower prices than if you had bought the stock directly. And personally, on the long term, this is really what I'm going to do with my portfolio, because for the moment, I don't have enough capital, for example, to cover the assignment on stocks like Caterpillar, where we need to put around $15,000 on the table just to cover the assignment. However, once I will have more capital, you can definitely be sure that that will be the way on how I actually invest in the markets. I will sell cash secured puts, and then once I'm being assigned, I will be happy to keep the 100 shares so as to now benefit from the dividends. I hope this video helped you understand why the cash secured put strategy can be so useful, and if you have a small capital, why not using the wheel strategy on cheap and liquid stocks. And if you don't know which cheap and liquid stocks you should use, know that I have created a watch list that I actually share in one of my videos. You'll find the link in this video, so you can actually benefit from cheap and liquid stocks. I really recommend you to use that watch list so you can benefit from the wheel strategy, because you can find really cheap stocks in there. If you've liked this video and you'd like to see more videos like this one where I explain some workflows that I like to use, then don't hesitate to like these videos, subscribe to my channel. As I said, it's really the best support you can give me, and I'd really appreciate it. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.